Welcome back to the Pro Ticker Podcast, everyone. It's your Thursday morning edition covering major financial magazine headlines. And we've got a lot to unpack today.
Yeah, there's a lot going on.
We've got profit warnings, we've got energy stocks surging, crypto acquisitions, the Fed, European gas, market movements in general, and even some Social Security changes, plus a little AI for good measure.
Quite the mix.
Well, our listeners, they send us these articles and they want to understand what's happening without getting lost in the weeds, right?
Absolutely. They want the big picture, the key insights, the aha moments.
Exactly. So that's what we're here to do. Let's dive in, shall we?
Let's do it.
Okay. First up, I gotta say, this MarketWatch headline caught my attention. A catering giant just warned on profits. The U.S. education and healthcare market are to blame.
Yeah, that's Sodexo, right? Huge company.
Exactly. Shares slumped 15%, two-year low. Not good.
Not good at all.
Yeah.
And the article goes on to say that they're blaming softer education volumes and delays in those healthcare contracts.
Makes you wonder, is this a Sodexo-specific issue?
Or maybe it's a canary in the coal mine for these sectors.
Right. Well, the article lays out the numbers. They had to slash their organic revenue growth forecast to 3-4% from like 5.5, 6.5%. And their underlying operating margins, instead of that 30 to 40 basis point jump they were hoping for, now they're only expecting 10 to 20.
Big difference.
Huge. Although they did say the first half of the year saw some growth.
3.5%, and margins did tick up a little bit to 5.2.
So not all doom and gloom, I guess.
Not entirely. And they did mention that some other regions like Australia and India were doing well, helped offset the U.S. weakness.
Okay, so some bright spots. But still, what stood out to you from that MarketWatch piece? Was it just Sodexo or these bigger problems brewing in education and healthcare?
Well, Sodexo's obviously dealing with its own specific contracts and clients, right?
Yeah.
But these challenges they're facing, they could be signs of bigger changes, like maybe in education, student demographics are shifting, or how they use campus services is changing.
Like those meal plans, maybe?
Exactly. Maybe students are looking for more flexible, cheaper options. And then in healthcare, those contract delays, maybe it's tighter budgets, or maybe they're rethinking how they outsource things. It's definitely something to watch. See if other companies in these sectors start reporting similar problems.
Good point. Okay, let's switch gears completely. Energy stocks. Bloomberg has this headline. Energy stocks, XLE, move into pole position as inflation anxiety climbs.
They are on a tear, aren't they?
Up almost 8% this year, even though oil prices are actually down about 6%. That's kind of weird, isn't it?
It is interesting. The article suggested it's all about inflation fears. Investors see energy stocks as a hedge against rising prices. If everything else is getting more expensive.
Then the value of energy companies, those producing these essential commodities, should go up too.
Right. They offer some protection from inflation eroding your portfolio.
So energy stocks are like a safe haven.
In a way, yeah. And the Bloomberg article mentions a few other things feeding this energy boom. There's this lingering inflation anxiety, a perception that the administration might be supportive of the industry, with that meeting President Trump had with oil execs.
Right.
And then there's always those geopolitical tensions, which can mess with energy supply chains.
Yeah, never a dull moment there. And this inflation fear isn't going away anytime soon either.
No. Bloomberg cites a University of Michigan survey that shows long-term inflation expectations are at their highest in over 30 years. Consumers are expecting prices to rise almost 4% annually over the next 5 to 10 years.
Wow. And even the Fed has upped their inflation estimates.
Right. Correct. So there are definitely some mixed opinions on where energy stocks go from here. Simon Lack from Catalyst Energy Infrastructure Fund seems pretty bullish. He thinks the White House's support for U.S. energy exports is a big positive.
But then you have someone like Eric Nuttall from 9 Point Partners who's more cautious.
Yeah, he points to uncertainties like the administration trying to lower oil prices and the possibility of more Russian oil supply coming online.
So even within the energy sector, there's no clear consensus.
Nope. But Bloomberg Intelligence does say the sector is set for double-digit profit growth later this year. So there's that.
Okay, now here's the thing that's really got me thinking. You've got Sodexo, the catering company, struggling because of rising costs, right?
Right.
And at the same time, you have energy stocks booming because investors are worried about rising costs. So is inflation hitting different parts of the economy in different ways?
I think you're onto something. It's not a one-size-fits-all situation. For a company like Sodexo, they provide a service, right? And in areas like education and healthcare, their ability to raise prices might be limited.
So their costs go up, but they can't necessarily charge more.
Exactly. And that squeezes their profits, lead to those warnings we saw. But energy companies, they're producing something that everyone needs.
And if everything else is getting more expensive, that benefits them.
To some extent, yes. Plus, there's this whole inflation hedge thing driving up demand for their stock. It's a complex picture.
Definitely. Okay, let's jump into the crypto world. The Wall Street Journal has this exclusive. Crypto exchange Kraken nears deal for futures trading business NinjaTrader. Sounds like a big deal.
Yeah, potentially huge. The WSJ says it's a $1.5 billion deal. Kraken, the crypto exchange, is buying NinjaTrader, which is a platform for trading futures.
And they could announce it as early as today?
That's what the article says.
Wow. And this NinjaTrader, they have over 1.8 million customers, and they provide all these tools for futures trading.
Exactly. But what's really interesting is that this acquisition could allow Kraken to start offering crypto futures and derivatives in the U.S.
Because of NinjaTrader's regulatory status.
Exactly. They're registered as a futures commission merchant, so they have the regulatory approval that Kraken needs.
So it's not just about the customers.
Nope. It's about getting that regulatory foothold. And the WSJ says Kraken also wants to use NinjaTrader to expand into the UK, Europe, and Australia.
Ambitious. And it fits with their broader goal of offering trading in other asset classes like stocks and even payments.
They want to be more than just a crypto exchange.
The article also mentions that the crypto industry is feeling more optimistic about regulation under the Trump administration.
And they point out that the SEC just dropped a lawsuit against Kraken.
Interesting timing. So what do you think? What does all this mean for the future of crypto? Is this a sign that it's becoming more mainstream, more integrated with traditional finance?
I think it's a big step in that direction. By acquiring a regulated platform like NinjaTrader, Kraken is moving deeper into the established financial system. And this more relaxed regulatory environment, it's definitely emboldening crypto companies to be more ambitious.
Makes sense. Okay, let's talk Fed. We've got articles from Bloomberg, the Wall Street Journal, and MarketWatch, all covering the Fed's latest decision and their economic outlook. Everyone was waiting for this.
For sure. And the big news is that they kept interest rates unchanged.
Yeah, for the second meeting in a row, they're staying in that 4.25 to 4.5% range.
And they're slowing down the pace of their balance sheet reduction. Bloomberg says they're dropping the monthly cap on Treasury maturities from $25 billion to just $5 billion starting in April.
Yeah, MarketWatch even pointed out that Governor Waller wasn't happy about that. He wanted them to keep shrinking the balance sheet faster.
Interesting dissent there. But overall, the Fed's message, as reported in all these articles, is that there's a lot of uncertainty about the economy. Inflation's a big concern, and the impact of President Trump's tariffs is adding to that uncertainty.
Right, and both the WSJ and MarketWatch say that the Fed has actually lowered their growth forecast for 2025 and raised their inflation estimates.
Slower growth, higher prices, not a great combo.
Definitely not. And Bloomberg pointed out this kind of weird disconnect. The Fed is predicting slower growth and higher inflation, but still expects to cut interest rates twice this year.
Although some officials are now saying maybe just one cut or even no cuts at all.
Okay, so mixed signals there.
Definitely.
But Jerome Powell, in his press conference, he seemed pretty chill about it all, right?
Yeah. Bloomberg even called him soothing. He acknowledged that inflation is ticking up, but said he hopes it's temporary. He even downplayed those long-term inflation expectations we talked about earlier from the University of Michigan survey.
Called them an outlier. So the market seems to have liked his message. Bloomberg says stocks rallied and bond yields fell after he spoke. And they say investors are now betting on even bigger rate cuts by the end of the year.
Interesting. But the WSJ does point out that there are still worries about stagflation. You know, that's stagnant growth with high inflation.
Right. Not a good situation. And MarketWatch reminds us that those tariffs the White House is planning to announce in April, well, those could make things even worse.
Yeah. Economists are worried they'll push inflation even higher and hurt growth. So it's like this weird situation. The Fed is saying don't worry, but their own projections are kind of worrying. Do you think the market's optimism is justified?
It's hard to say. Maybe they're just relieved that the Fed isn't raising rates immediately. And Powell's emphasis on being data dependent, maybe that's giving them hope that rate cuts are still on the table. But those underlying economic projections are concerning.
Agreed. And thinking back to those energy stocks, those tariff uncertainties are probably contributing to those inflation fears that are making energy so attractive right now.
And if tariffs make imported goods more expensive, that could actually help domestic energy producers keep their prices higher.
Another layer of complexity.
Definitely. Okay, let's hop over to Europe. Bloomberg reports that Germany, France push to lower EU gas storage goal from next year. What's that all about?
So right now, the EU requires countries to have their gas storage 90% full by November 1st every year. But Germany and France want to lower that to 80%.
Why?
Well, they say that the rigid 90% target actually leads to more market speculation. They argue that the mandatory buying to meet that target by a specific date creates predictable demand spikes that traders can exploit to drive up prices. But the European Commission, according to Bloomberg, they're against this idea. They say that storage target is crucial for energy security, especially with all the geopolitical tension and less gas flowing from Russia.
And Bloomberg reminds us that this past winter, Europe used up its gas reserves faster than usual.
Combination of cold weather, low wind power generation, and, of course, those reduced supplies from Russia. It all led to more price volatility. So how do you think this potential change in the EU's gas storage goal would affect global energy markets, especially with all those other uncertainties we talked about?
It's hard to say for sure. On the one hand, if Europe is buying less gas to meet that storage target, that could lower demand and potentially ease some price pressure in the global market. But on the other hand, if something unexpected happens, like a sudden supply disruption, having less gas in storage could make things really volatile.
Exactly. It's a trade-off between lower prices in the short term and potentially bigger problems down the road if there's a crisis.
Makes sense. All right, let's take a quick look at the broader market snapshot. It looks like a mixed bag today.
Yeah, Asian markets were up and down, while European stocks ended the day higher. Treasury yields dipped a bit. The Wall Street Journal also mentioned that the Swiss National Bank cut interest rates, but Sweden's central bank held steady.
Interesting. And in commodities, egg prices are apparently plummeting.
That's good news for breakfast lovers.
For sure. Oil prices went up and gold hit another record high. And copper, that's up too, breaking above $10,000 a ton.
All those tariff worries.
Yep. And the VIX, that's the fear gauge, that ticked up a bit too. So what's your overall read on the market's mood? Cautious optimism or underlying anxiety?
It's a bit of both, honestly. The market seems to be taking some comfort from the Fed's dovish tone, but those gains in safe haven assets like gold and the rise in the VIX suggest there's definitely some nervousness out there.
A lot to be nervous about, I guess. Okay, one last thing before we wrap up. Social Security. MarketWatch says Social Security pushes some beneficiaries to online or in-person meetings.
Yeah, they're implementing new security measures to fight fraud, especially for benefit claims and changes to direct deposit info.
So to verify your identity, you'll now need to either access your account online through My Social Security or go to an in-person appointment.
And even if you start the process on the phone, you'll still have to finish it online or in person.
Okay. But the good news is that MarketWatch says they're speeding up the processing time for direct deposit changes to just 1 business day.
That is good news. But the article also points out that these changes could make things difficult for some beneficiaries, especially older folks, people with disabilities, those who don't have internet access, or those who have trouble traveling to a Social Security office.
Right. Accessibility is a big concern. And MarketWatch mentions that these changes come on top of those cost-cutting measures and staff reductions the SSA announced earlier.
So it's like they're making things harder for some people at the same time that they're cutting back on resources.
Definitely something to keep an eye on. It's a tricky balance, right? Making things more secure, but also making sure everyone can access their benefits.
Exactly.
All right, last but not least, let's talk AI. MarketWatch reports that SoftBank expands its AI footprint with $6.5 billion purchase of Ampere Computing. That's a lot of money.
It is. SoftBank is buying a semiconductor designer, basically a company that makes the chips that power data centers.
And those data centers are crucial for AI, right?
Absolutely. There where all the heavy lifting happens, the training of those massive AI models.
Makes sense. And this is just the latest in a string of AI investments by SoftBank. They already have a big stake in ARM. They're partnering with Oracle and OpenAI on that Stargate initiative. And there are rumors of even more investment in OpenAI coming.
SoftBank is going all in on AI.
Seems like it. And Masayoshi Son, their chairman, he's a huge believer in AI. He even talks about it evolving into super wisdom someday. So with all the economic uncertainties we've been talking about, how significant do you think these massive investments in AI are? Could they be the key to future economic growth?
I think they have the potential to be a major driver of growth. AI has the power to revolutionize so many industries. From healthcare to manufacturing to finance, it can boost productivity, create new products and services, and even open up entirely new markets. So even with all the challenges we're facing right now, these investments in AI could be a bright spot for the future.
A lot to think about. So today we've covered a lot of ground.
Yeah.
Inflation, energy, crypto, the Fed, European gas, market jitters, Social Security, and even a bit of AI.
It's been quite the journey.
It has. And the main takeaway for our listeners is that the economic landscape is constantly shifting. You have these policy decisions, global events, technological breakthroughs, all interacting in complex ways.
It's important to understand how these seemingly separate trends are connected.
Exactly. It helps you make sense of the bigger picture.
And it leaves us with a big question to ponder. How do you weigh the potential long-term impact of something like AI against the more immediate concerns about inflation and economic growth?
Food for thought. Well, thank you for joining us today on The Deep Dive. We'll see you all tomorrow morning with new headlines from major financial magazines.
See you then.